Hey guys, welcome back to my channel. In today's video, I'll be sharing with you Peter Lynch's rule on when to sell. Many investors only focus on when to buy and what to buy. But one of the most important, if not the most important, is when to sell. Because you can buy the wrong stock at the wrong time, but if you sell it at the right time, you still are able to make some profits. But on the other hand, even if you buy the right stock at the right time, but sell it at the wrong time, you can lose money. And that is why when to sell is so important when we are investing in the stock market. So in today's video, I'll be sharing with you some of Peter Lynch's advice on when to sell. Who is Peter Lynch and why do we want to listen to Peter Lynch? Peter Lynch was a manager of Magellan Fund between 1977 and 1990. And during his time as manager of the Magellan Fund, his fund averaged a 29.2% annual returns. And with that kind of returns, it makes Peter Lynch Magellan Fund the best performing fund in the world at that time. And Magellan Fund's asset under management, or AUM, grew from $18 million to $14 billion. So it's safe to say that Peter Lynch knows what he is doing when investing in the stock market. If you want to determine when to sell your stock, the first thing that you need to do is, before you even sell the stock, you need to know why you bought the stock in the first place. Because if you know why you bought the stock in the first place, you will have a better idea of when to sell. For example, if you bought the stock for investing purposes, you know that in the short term, the stock will definitely face some volatility in its price movements. So when the stock you bought actually experienced volatility, you have the confidence and conviction to hold on to your stock for the long term. And you only sell the stock when the stock hits your price target, and not because you panic and sold the stock when the stock experienced volatility. Therefore, it's very important before you sell that you know why you bought the stock in the first place. And according to Peter Lynch, there are 6 categories of stocks in the stock market, and these individual categories differ from one another. And if you understand which category that your stock falls under, you'll know the characteristics of the stock and why you bought the stock in the first place. And after that, once you know the reason why you bought the stock, you'll have a better idea of when to sell that stock. Now, let's take a look at Peter Lynch's 6 categories of stock. The first category are slow growers. For a more in-depth explanation of what these 6 categories of stocks are, check out my video over the top right of your screen. So it will be better if you check out that video first and then come back to this video. Okay, so for slow growers, we want to sell when there's been a 30 to 50% price appreciation or when the fundamentals have deteriorated. Another thing to pay attention to is that the company has lost market share for 2 consecutive years and is hiring another ad agency. No new products are being developed, spending on R&D is curtailed, and the company appears to be resting on its laurels. On top of that, 2 recent acquisitions of unrelated businesses looks like diversification, and the company announces it is looking for further acquisitions. And the company has paid so much for its acquisitions that the balance sheet has deteriorated from no debt and millions in cash to no cash and millions in debt. And there are no surplus funds to buy back stock, even if the price falls sharply. So if your stock is a slow grower and it displays most of these characteristics, then Peter Lynch believes that it's time to sell that stock. For fast growers, if 40 Wall Street analysts are giving the stock their highest recommendation, 60% of the shares are held by institutions, and 3 national magazines have fawned over the CEO, then it's definitely time to think about selling. Right? Because Peter Lynch believes that for fast growers, if there are too many people noticing the stock, then these fast growers are unlikely to experience the growth that they experienced before. And these fast growers, unlike the cyclical, where the PE ratio gets smaller near the end, in a growth company or fast growers, the PE usually gets bigger and it may reach an absurd and illogical dimension. So you want to do your research and observe whether the company is still able to grow. Has it reached close to its value of its total addressable market? If your fast grower is experiencing saturation point, then the room for growth is likely to be limited. And that is one potential sign for you to sell your fast growers. On top of that, same-store sales are down 3% in the last quarter and new store results are disappointing. And you'll see that top executives and several key employees leave to join a rival firm. And the company will return from roadshows telling an extremely positive story to institutional investors. So if the company is doing more roadshows rather than focusing on managing its business and improving it, then this is also a possible sign for you to start selling your fast growers. Another point to take note is that the stock is selling at a high PE, while the most optimistic projections of earnings growth are lesser than that for the next 2 years. For example, the fast grower has a PE of 30, while growth is 15 to 20%. If the PE of fast growers are outstripping the earnings growth, then this is also something for you to pay attention to. The third category of stocks are stalwarts. For stalwarts, if the stock price gets above the earnings line, or if the PE strays too far beyond the normal range, then you can start thinking about selling it and waiting to buy it back at a lower price or buying something else. Because for stalwarts, even though they experience growth, they don't experience the kind of growth that fast growers experience. And that is why we want to pay attention to if the stock price gets above the earnings line, or if the PE strays too far beyond beyond the normal range. Some other signs to pay attention to is that new products introduced in the last 2 years have had mixed results, and others still in the testing stage are a year away from the marketplace. And another thing to take note is insider buying. No officers or directors have bought shares in the last year, and I think this is one of the more important points. If insiders aren't buying, then there's a high probability that the insiders themselves do not believe in their own company. Another sign for you to take note on when to sell Stalwarts is that the stock has a PE of 15, while similar quality companies in the same industry have PE of around 11 to 12. And a major division that contributes 25% of earnings is vulnerable to an economic slump that's taking place. Another point to take note is that the company's growth rate has been slowing down, and though it's been maintaining profits by cutting costs, future cost-cutting opportunities are limited. So even though the company is able to maintain its profits are maintained because of the reduction in costs rather than an increase in sales and the growth of a company. And as such, these are not sustainable. The fourth category of stocks are turnarounds. And the best time to sell a turnaround is after its turnaround. That's pretty obvious, right? Yeah, but according to Peter Lynch, this is the best time to actually sell a turnaround. For turnarounds, the time to sell is actually when all the troubles are over and everybody knows about it. And the time to sell is when the company is no longer turnaround and it has become its old self before it fell apart. So once a turnaround stock changed to another category, then this is a time to sell the stock. Because if the turnaround has been successful, we have to reclassify the stock. And when we reclassify the stock, there'll be different signs for us to pay attention to on when to sell that stock. So in summary, the turnaround stock has turned around already. And that is when we want to start selling the stock. For the fifth category of stocks, it's the cyclicals. And Peter Lynch mentioned that we want to sell towards the end of the cycle. But then again, no one can predict the end of a cycle accurately. So knowing the difficulties of predicting accurately on when the end of the cycle is, Peter Lynch mentioned that we can start to sell when something has started to go wrong. So for example, costs have started to rise, inventories are building up, and the company can't get rid of them. And we see competition businesses starting up. This is also a bad sign because the outsider will have to win customers by cutting prices, which forces everyone else to cut prices and leads to lower earnings for all the producers. And final demand for product will be slowing down, and the company has tried to cut costs but still can't compete with foreign producers. So for cyclicals, Peter Lynch said that basically whatever inspired us to buy between the last bust and the latest boom will give us clue on when the latest boom is over. Right, so for cyclical stocks, these stocks tend to follow the market cycle very closely. So if we bought these cyclical stocks in the early part of the market cycle, believing that there's still some room for growth in the market cycle, and then now we are towards the end of the market cycle, then we can start considering to sell these stocks. For asset plays, as long as the company isn't going on a debt binge, thus reducing the value of the assets, then we want to hold on. The selling sign will be the opposite of this. If the company is going on a debt binge and reducing the value of its assets, then we want to look to sell our stocks which are the asset plays. Another sign to pay attention to when considering on when to sell asset plays is that although the shares are selling at a discount to real market value, the management has announced that it will issue 10% more shares to help finance a diversification program. And the reason why this is a potential sell sign is because the issuance of more shares will dilute the existing shares of shareholders. Another sign is that the division that was expected to be sold for 20 million only brings 12 million in actual sale. And I believe this is the most important point when taking into account for asset plays. Because for asset plays, we are buying a stock purely for its assets. So for example, if we value the division to be $20 million, but the company is only able to sell the asset for $12 million, what this tells us is that the company has to sell its assets at a discount. And that goes against the very reason why we buy stocks which are asset plays. Another sign to pay attention to is institutional ownership. If institutional ownership has risen from 25% a few years ago to 60% now, then this is another potential sign to sell your asset play. Alright, so I know there's a lot of things to take note of. And if you haven't watched my other video, there'll be some things that you will be confused about. So my advice to you is watch my other video first and then come back to watching this video. And I believe that once you have a good understanding of the other video, all of the things that I mentioned in this video will start to make more sense. If you have learned something from this video, smash that like button because it will really help the channel grow and allow me to produce more content such as this. And don't forget to subscribe to my channel because each week I release new videos about investing, trading, and the stock market. I will see you in those other videos. To your financial success.